And I suspect that somebody is going to get bit. I mean, certainly the idea that the Tiger Fund, the legendary hedge fund, ended up $18 billion on the wrong side of the tech trade tells you that there is some big money, some serious money that is large and seriously wrong. And I suspect that one or two of those is going to surface. The second thing that I'm interested in is simply that in circumstances where you have sea changes in market conditions, that investors often don't have enough education or operate too much on narrative. And what happens is that they throw out the babies with the bathwater, which is to say, when people get scared, they sell anything with a bid, good, bad, or ugly. And to the extent that I was complaining about the price levels of junior resource stocks as recently as a month ago, some of those junior resource stocks are coming down to the period where they're worth buying. And if this liquidity continues, they're going to come down to the level where they're worth gobbling. So I'm looking at two things. I'm looking at who's going to blow up and what impact that might have on the overall market. But I'm probably more interested in how, with my own personal liquidity, I can take advantage of other people's illiquidity.
I heard you say that recently. I don't know if it was at the Vancouver conference, or that in the past year or two, a lot of these resource companies that were doing private placements, the terms favored them because they were hot. And now the terms might be coming back towards the investor side because money's getting a little bit tougher to find to fund different projects. You want to talk about what you said?
Yeah, I mean, the truth is that I've made both my fortune and my reputation really by operating in microcap markets where the distribution of information was inefficient and where the markets were even more volatile than regular markets. And I have always tried to be a source of capital when other sources of capital weren't available. Capital has been very freely available for the last 5 years, which has meant that the terms in private placement has favored the issuer rather than favoring the check writer. I'm not trying to say that I need to buy everything for a dime on the dollar. But what I am saying is in the exploration business where the expectation is failure, I need a proper incentive to participate in a private placement where the incentive is failure. That incentive is often a long, full warrant. And those warrants haven't been on offer. I have counseled people for many years, 30 years at least, that the correct answer when offered a private placement without sufficient warrant inducement is to say no. Why would you sign yourself up for a large position in an illiquid stock when you could buy it in the market without a hold period? The only incentive that you have is the ability to participate after the fact in the exploration success that might result from the capital that you put in the company. I had a wonderful circumstance in Vancouver with a well-known exploration guy who I've known for a very long time, technically very good, promotionally not so good. And he sort of cornered me and said, what would it take? I'm going to have to come back to market. We've done business for a long time. What would it take? I said, you know me. You just have to refresh your familiarity with the dictionary. Look up warrant and talk to me about a big one with a long option period. And we can have a discussion right away. Jim, it's interesting that when a management team issues a 5-year warrant, they call it dilution. And when they issue a 5-year stock option to themselves, it's called an incentive.
That's a good point.
And sometimes when I have this discussion with these guys, what's the difference? They say, well, that's not fair. I work for the company 5 days a week. At which point I say, you're right. It's not fair. My money's working there 7 days a week. So reasonably, I should get 7/12 and you should get 5/12.
Rick, let's start talking about what's happening on Wall Street. First, it was SPACs, and then tech got hit hard. What's safe right now? What are you buying right now?
I am now very, very aggressively involved in my own lending business and this bank that I'm starting. I am keeping powder dry because I see the microcap resource market coming to me. I've been involved in these markets before, and the market that we have in 2022 seems to me to be a market where I can turn $10 million into $50 million, which is attractive. Were I buying on Wall Street, and I'm not, I would be buying the big sector dominators that have such strong, durable competitive advantage that it's reflected in margins. Johnson & Johnson, Shearing Plow, Procter & Gamble. The right proxy for that is probably the Dividend Aristocrats ETF, symbol NOBL. By the way, I'm saying this for other people's money, not for my own.
Yeah.
But were I buying on Wall Street, I would be buying the sector dominators. Mm-hmm. I'd be buying the companies that had 30-year track records with regards to cash margins, market share, sales growth, that were reasonably conservatively financed. And what I have always liked about the Dividend Aristocrats is that that's an ETF that's made up of companies that have met or exceeded their dividend every quarter for 30 years. Mm-hmm. A lot of earning stability. My friend Doug Casey used to describe earned dividends as, quote, outward manifestations of inward grace. And I love that description. And were I of a mind to be invested in Wall Street, that's where I would be invested.
Well, you've often said that you're more of a commodity speculator, and two of your favorite sectors you've said many times are uranium and silver. Are those still your two favorites, or are there some other commodities you're watching at this moment?
It depends on who you are. If you're an investor, not a speculator. If you're an investor, I prefer oil and gas because the companies are generating so much cash and they're so cheap. And the industry as a whole isn't investing enough sustaining capital to maintain production. So that circumstance continues. As a speculator, certainly the upside volatility is in silver and uranium. Uranium is so volatile right now, you're almost forced to be a trader, which is not what I do. But you see these stocks go up 30 or 40% in 3 or 4 weeks. And you see this incredible euphoria. Mm-hmm. And then you see the stocks collapse. You can almost understand how to trade uranium stocks by watching the number of views that my uranium YouTube interviews get. If the interview is over 30,000 views, you should be a seller. And if the interview is under 6,000 views, you should probably be a buyer. That isn't what I like to do. What I really like to do is buy something deeply out of favor, participate in a couple placements, and sell it 5 years later for a 10x. That's sort of my preference. But the truth is, if somebody gives you more than you deserve in 4 or 5 weeks, you're probably duty bound to take it. Silver is a different circumstance. The luster is off silver, pardon the pun. And I love that circumstance. I love circumstances where very high quality development names like Silvercrest are off by half. And I'm prepared to believe it might take 1.5 years or 2 years for silver to find its way back into speculative favor, which is fine for me. I'm 69 years of age. I've, as an investor, lived through 25 2-year periods. If it takes me 2 years to see the silver price go from some number like 20 to some number like 50 or 60, if it takes me 2 years to see the high quality silver companies triple and the best of the leveraged silver companies to go up 10 for 1, I'm okay with that. And the fact that I can sit back at my leisure for the next 6 or 7 months and not be rushed into decisions because I'm competing with 10,000 morons in the market, it's just a wonderful circumstance. We can take a look at a company. I can have the geologists sort of digest it. We can let the lawyers look at it from a community relations and ESG point of view. We can do our own work in terms of the interplay between the balance sheet and the income statement. Look, as an example, how much money is spent in G&A relative to assets under management. Do all the kind of work that you're supposed to do before you invest. And that level of due diligence was impossible to do 2 years ago because the stocks were moving too fast.
You mentioned Silvercrest, and that's a big name. It's a really high quality asset that I think it's about to come onto production and they're ramping up to 12 million ounces a year. Is that and you're right, the stock is way off. It's gotten sold out, thrown out with the bathwater. And there's good names like Silvercrest that have come down a lot. Is that the type of name you would tell people to take a close look at? A high quality producer like that?
Most people, yes. Look for something where maybe the story is behind the company, or something that sold off just because it stopped going up. There are a bunch of people who own Silvercrest that have no idea why they owned it. And the consequence of that is that many of them sold it, not having the courage of their convictions. If you've spent as much time on Silvercrest as I have, and if you've had the benefit of being part of Sprott, which was there from before the time it was public, you can have a reasonably high degree of confidence. If you see a deposit that's absolutely positively going to grow, which it is, and you see a deposit that's in the quiet period leading up to production, which it is, and you see it in a sector where the commodity's out of favor and you think it's going to go up, and you think as a consequence of that after the commodity goes up, the sector's going to re-rate. If in your own mind you are willing not to have too much psychological verification, I think that it's not unreasonable to look at a 5-year 5-bagger. And that's sort of fun.
Yeah, their cost of production is ridiculously low, way lower than the industry average. And that's really what you want to look for a silver play, correct?
Well, it certainly gives you coverage to the downside. If it takes longer for silver to recover, those guys make a lot of money at $18. I happen to believe that on a nominal dollar basis, that in the next 5 years, silver trades north of 50. And so I always run myself a $20 case, and then I run a $25 case, and then I run a $50 case. And I do valuations on a matrix of pricing assumptions. Ironically, the companies that don't make any money at all at $20 are the guys that generate the largest pro forma increases at $50, which is to say the inefficient producers offer more leverage.
Mm-hmm.
But I'm inclined to look at both my upside and my downside. And if I have circumstances where at $20 I don't have a downside, I can afford to be a little more generous with myself in terms of what upside I'm willing to take. And I think Silvercrest is a wonderful example. I didn't mean it as an example to be a stock recommendation. It's because I don't know everybody in your audience. I can't give them recommendations. But as a learning exercise, the value proposition around Silvercrest is, I think, instrumental. Another name, just for educational purposes, would be Pan American. Hammered in price. I think, because of the real expectation of increasing political risk in Mexico and Peru. Mm-hmm. Hammered partly because 55% of their revenues are gold now, not silver. Interestingly, all kinds of operating leverage in the company. And importantly, 2 deposits in the company which don't figure into the market capitalization because they're not producing. One in Guatemala, Escobal, 500 million ounce deposit, high grade deposit. The other, the name escapes me, Navidad in Argentina, 500 million ounces. If they received the go-ahead on either of those deposits, they could more than double Pan American's production. Yeah. To have that sort of leverage baked into the company, but not baked into the market cap, is an unusual opportunity. And it's the kind of opportunity you only see in markets like this.
Yeah, Rick, former Fed Chair Bernanke this week came out and said the Fed made a huge mistake, and they're way too late to respond to inflation. Are you surprised he made those comments?
Their job is to lie. Um, they, the political class, including the Fed, knew that the voters didn't want to take the bitter pill. Everybody liked the party, and nobody wanted the vodka to come out of the punch bowl. It's easy to say we screwed up. They knew 8 years ago they were screwing up. They knew 5 years ago they were screwing up. They knew 2 years they were screwing up, and now he gets to do a mea culpa. Mm-hmm. So, am I surprised? No. And am I surprised, by the way, that the voters wouldn't allow the politicians, and the politicians had no interest anyway, in doing the right thing? Mm-hmm. Think about what doing the right thing would be for those of your listeners who were around in 81, 82, 83. Volcker did the right thing, and it was extremely unpleasant for people who were marginally employed or involved in marginal businesses. And doing the right thing here, allowing a free market at interest rates, would mean, as an example, that the U.S. 10-year Treasury, if the CPI stated rate of inflation is at 6.5, probably a conservative estimate, that would mean that the U.S. 10-year Treasury would be at 7. That would mean that federal, state, and local governmental budgets, just the interest payable, would triple. Traditionally, the 30-year fixed mortgage rate trades in front of the 10-year, which is to say that the 30-year fixed mortgage rate would go from sort of 4 to some number that had an 8 handle on it. That would be a bit of a challenge for people trying to afford houses, and then after that for people trying to sell houses. Traditionally, too, revolving consumer credit, which is to say credit card credit, traditionally has traded at 1,000 or 1,100 basis point premium to the Treasury, which means that on people's credit card debt, if the Treasury was trading to yield a 7, revolving consumer debt would increase from some number like 12 to some number like 18. And I think that would be very difficult for consumers. So while I certainly believe that we should have a free market at interest rates, that the Fed should get out of the way, the consequences for 2 or 3 years for American consumers and American voters would be interesting, to say the least.
Well, what we're facing, all the pressure right now on the Fed is to fight inflation, of all the political pressure. So they got to tighten. And at some point in this process, the economy is probably going to roll over. Housing prices will start trending down. Maybe unemployment will start ticking up. Maybe the market tanks another 30%, or, some catastrophic day where everything's down 10%. Something like that's likely going to happen at some point in this tightening process. Is that the pivot point, you think, before the political pressure changes and then the pressures on the Fed save the economy, screw inflation? Forget inflation.
I think we've already started in some sectors that narrative. Clearly, the most important determinant in reducing equities prices has been higher interest rates. Higher interest rates increase the cost of capital to corporate America, which puts a cramp on earnings, at the same time that they lower the capitalized value of dividend distributions. So both the numerator and the denominator turn south. And, that's hard on people. Imagine yourself running a great big university endowment or pension plan. You have 2 problems. One, the net asset value assumptions that you made, the return assumptions that you've made, all turn negative in the equity market. And in the debt market, you're earning 4% in a currency that's depreciating by 6.5 or 7%. So what you do is you go to your bosses in state government or at the university and say, you guys have to increase your contributions to the pension fund. Mm-hmm. And they come back and say, no. No. This is between a rock and a hard place. And that's where we are.
So, hey, Rick, you have something coming up in July that I'm going to attend that I wanted to ask you about. It's July 26th through the 29th in Boca Raton on the beach. I'm going to see you in a Speedo there on the beach, I heard. The Natural Resources Investment Symposium. Tell us what's going on there.
Well, first of all, you're not going to see me on the beach in a Speedo, which would be
Okay.
very, very bad for attendance. Probably good for daiquiri sales. In all seriousness, we have, meaning I really, have put on conferences for a long time in Vancouver. The Natural Resources Investment Symposium, then the Sprott Natural Resources Investment Symposium, now the Rural Natural Resources Investment Symposium. For the last couple of years, we couldn't put it on in Vancouver because of COVID. Public health concerns in 2 countries meant that I couldn't rationally move investors across national borders. Those same investors who have been attending our conferences for 20 years told me that they wanted a live conference now. Not being able to do it in Vancouver, we're going to do it in Boca Raton, Florida. Why should people go? Well, really for 4 reasons. The fact that we've put on the conference for 27 years means that the customers have always liked the conference. Why? First of all, great big picture thinkers. The kind of big thinking speakers that you don't get in the Wall Street Journal or CNBC, the Nomi Prinzes, the Jim Rickards, the Daniela Martino Booths, the Grant Williams, the Bill Bonners, people who don't normally speak at investment conferences, people who can set the macro stage in a way that you don't hear macro topics discussed in most mediums which are available to investors. We've done a great job over the years framing the big picture social and political and economic issues well. More importantly, though, this has been a great industry conference. Every year, we have presenters who come to our audience and say, I built a multi-billion-dollar public natural resource company from scratch. Here's how I did it. And here's how the lessons that I learned have made me a better natural resource investor. And here's how you can become a better natural resource investor. This isn't information that comes from gurus. This is information that comes from people who have done it where the rubber meets the road.
Yeah.
The third thing is that at our conference, unlike any other conference I know, to be an exhibitor at our conference, you have to be owned in a Sprott managed account or in my own account. That doesn't mean, Jim, sadly, that every stock I own goes up. What it does mean is that every exhibitor has been very thoroughly vetted. We understand the risk reward parameters around every exhibitor well enough that we own them. I guess the fourth thing that's wonderful is the sort of interplay between a whole community of very knowledgeable investors and the various exhibitors and the various presenters. I remember 4 years ago following at a discrete distance Robert Friedland and differently Ross Beatty around the exhibit floor and noting what exhibitors they stood in front of, noting whether they smiled or frowned when they were getting answers to their questions. The idea that I can follow 2 spectacular billionaire investors and company builders and get a sense of what they're doing with their own money in real time, I found was worthwhile. So all those 4 elements to value means that I can say to anybody who wants to come down to Boca Raton and see this conference, if you come and you pay your tuition and you think at the end of the conference that you didn't get your money's worth, tell me, and I'll give you a full refund. Every rural investment media educational product for the last 25 years has come with a full money back guarantee. And this one's no different. Trying to find another conference with a full money back guarantee that vets all of the exhibitors by owning them will bring you at the end of the search to one conference. That's mine.
And I will be there. I know Economic Ninja told me he's also going to be there. And hey, if you want to put us on a panel, we'll be happy to say some things too.
Well, I mean, what I'm excited about with Economic Ninja and you is the opportunity to do on-air